Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Opened the week extending the move that we saw last week, the breakout move. Remember we talked about that 312 year-to-date high in yields, and it was really tough to get through. We had struggled getting through 3%. We did it. We struggled getting through 312. We did it. We made a move last week all the way up towards 320, a little bit above it, and then this week we opened up pushing up towards 3.25. So the yield was actually saw a higher mark earlier in the week. Alas, all things that go up must come down. And I saw what we saw to this week from a technical perspective. We saw yields move back towards into that range. They did not get back below the old year-to-date high. So still holding in that, I wouldn't call it a higher yield momentum move, but right now it's sort of cooled off, but we certainly didn't flip it. Momentum hasn't quite flipped yet. We need to see a move back below 310 to 12 area in yield in order to see that momentum start to flip. And if we got back below 3%, I think it would erase everything that we've done here over the last week or so. So right now yields, while they're off their highs, we're still not sure where we're going to find our footing. If we get below the 312 level, look out. That could be a move back towards 3%. And if you look at market volatility, while we did see a big boost in volatility when yields broke out of the range, things kind of subsided this week. Yeah, we did see that early week high. We did see that early week push higher in yields. And yeah, we did have 3 auctions this week, which really probably should have fed yields higher and didn't, which was a surprise. And I think that right now market volatility is starting to ease off those highs we saw on the high yields. However, month to date, we are still higher. If you go back to the end of September, things are significantly higher. So we may be seeing a new trend here. Higher volatility would mean higher, wider price springs, and at least not the same trade we've seen, which is a slow and steady move up and then a slow and steady back to the mean, and a slow and steady move down and a slow and steady back to the mean. And that's really what it's been about, and market volatility has been very low. Now we're off those lows and maybe for a while. And if you look at next week, what do we have ahead? Well, the key to next week to rates is going to be the FOMC minutes that come out on Wednesday. Yeah, those are the ones that usually provide a little more boom to the market than do the actual announcements, especially now that we're looking underneath the tea leaves. We know that the Fed is going to be raising rates in December, but what are they going to be looking at beyond December? I think that's really what the market is looking at, and part of the reason why we saw yields collapse at the end of this week, because I think looking forward, there isn't real clarity. The Fed has said what they want to do. Remember, never believe anything a Fed speaker says until it's first denied, and they haven't denied that they may not be able to raise rates aggressively next year. They still want to do that. They still see the economy and inflation working together in tandem to help the Fed raise rates, and I think that that's probably a positive at this point, but the clarity right now is so unclear. And if you look at what's happening in equities, spikes higher in the VIX, massive moves lower. It's a long liquidation in equities, and likewise, I think it's a short cover that we saw late in the week here in Treasuries. So right now, Treasuries going into next week into FOMC minutes with a little bit of a positive tone. However, we need to see that yield get back below 312 if we're going to see any kind of movement. This is Todd Colvin coming to you from the floor of the CME Group.